I'm a numbers guy. I always say, yeah, you have to run the numbers if you're going to make any sense out of a deal. But I also tried to emphasize very, very strongly that you had to look not only at the numbers, but beyond the numbers.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California, reminding you that there is a website associated with this podcast called wealthformula.com. That is where you go to take advantage of some of the resources of Wealth Formula that are not on this podcast. For example, an opportunity to join the Accredited Investor Club. I highly encourage you to do that, especially towards the end of the year here. Lots of tax mitigating investments coming through. Now, these are all private investments, and they are limited to accredited investors. Now, an accredited investor is not something that you have to apply for. It's something that you are or you are not. It depends on your financial situation. If you make $200,000 per year for 2 years in a row with reasonable expectation of continuing to do so, you are an accredited investor. If you're filing jointly, that number goes to $300,000. The other category is, of course, simply having a net worth of $1 million outside of your personal residence. If you meet those requirements, congratulations, you're an accredited investor, and you can sign up for Investor Club at wealthformula.com. And it's free to join and basically gives you an opportunity to see private deal flow that you are not going to see anywhere else. So go to wealthformula.com and join Investor Club. Now, I want to tell you a story, okay? I want to tell you a story. I grew up with a very different perspective on personal finance, investing than most. And some of you know, my parents were immigrants, and they arrived in this country without any preconceived notions of conventional financial wisdom. Why? Well, my father grew up dirt poor in India, and some of you might know that's really poor. That's very poor. So he never even had that concept or even heard the word investing as a kid. The one thing he was blessed with a tremendous intellect, very, very smart guy, got himself through high school and college by tutoring, that kind of thing, top of his class, and finally used that to come to the United States. And honestly, he truly did rise from the ashes to live the American dream. So that was the 1960s. He came to the U.S. in the 60s on an engineering scholarship and started working as a bridge engineer in Minnesota after he got his master's degree. And when he finally began making a little bit of money, he was confronted with the idea of investing for the first time. You see, again, until then, life had always been hand to mouth. And so he was approaching investing like an alien coming to this planet for the first time with an unbiased view on anything financial. And with that perspective, the stock market itself didn't really make sense to him. To him, it looked a little bit like a casino. It looked like you put money in, then it might go up, it might not, it might go down. What he really wanted was cash flow that would immediately improve his quality of life. So with whatever money he could scrape together, he bought small rental properties. Nothing glamorous, low income, single family homes, duplexes in Minneapolis where he was. But guess what? It worked. And before long, he started making real money and quit engineering altogether. The real story there is not that he quit, but that his boss found him spending too much time on real estate and decided that maybe he ought to find another job, or maybe just go into real estate altogether, which he did. Okay, so that story's funny because the apple didn't fall far from the tree. I guess years later, I would also walk away from my career as a physician and become a full-time investor. Back to my father, he did really well, right? Back in the 80s, he was having some years where he was making $1 million a year. And that's a lot now, but back then that was a lot more money. And I was making $1 million in the 80s. That was you really had to do well. But then came the 90s, and like many others in the dot-com era, he got in over his skis. You see, the thing is, he looked around and everyone was making easy money. Everyone was making money in the stock market, and he got greedy. So unfortunately, he sold a large chunk, if not most, of his real estate portfolio and went all in on tech. Oh, this man knows nothing about, that market, right? He knows nothing about technology, even though he's an engineer. He's a bridge engineer, just good math and physics and stuff like that. But no, he's not a tech guy. And of course, when it comes to the dot-com era, anyway, we all know how that ended. The bubble burst, and so did his brokerage account and basically his life savings. So there he was in his 50s, starting over again after being obliterated by the dot-com bubble. He was terrified. I could tell. I saw it in his face. I kind of tried to stay away. But he also knew what he had to do. Come on. You got to do something. So he rebuilt the same way he had built the first time around, which was starting to accumulate cash flowing real estate, one single family house and duplex at a time. And you know what? He's in his, he is in his mid 80s, and he's still at it. Now, I don't want to romanticize this real estate career entirely, because the reality is, like any career, it wasn't all smooth sailing either. It's not a fairy tale, right? It's real life. So, for example, I remember in the late 90s, and I was in medical school, Alan Greenspan, who was the Fed chair, suddenly cranked up interest rates, creating a situation not unlike what investors faced post-COVID recently when the Fed raised rates at a record speed. And you know what? That hurt him, and he lost money. But each setback brought lessons, and he kept moving forward, ultimately with an asset class that he trusted because he knew what went wrong. And the dot-com thing, he didn't know what went wrong. He couldn't really, he didn't know anything but these companies, and he couldn't kind of just, get under the hood and figure out what he did wrong and learn from it and move on. So he did this, eventually he recovered financially. I have to say that he was comfortable enough. He sent 3 kids to college, including me, who he also sent me to medical school. Yes, that's right. I didn't have any loans in medical school. And you know what? He'll be the first one to tell you that his lesson on the financial life was that he only ever really made money in real estate, and that's what he believes in. So why am I telling you all this? Because you see, it really ultimately shaped the way I see investing. Unlike most, I didn't grow up hearing that the stock market was sort of the safe thing to do, that stocks, bonds, and mutual funds were sort of conventional wisdom. I learned that the stock market was really risky, and I actually saw it with my own eyes when he got obliterated. So what the view that I had, the lens that I was looking at, was pretty much the opposite of everyone that grew up around me. And so for me, the default was real estate. And despite my own challenges from, post-COVID rate hikes, etc., I can still say that without hesitation, focusing on real estate has served me way better than following a traditional investing playbook ever would. Still, the thing is, you get in the space, and you have a bunch of wins. You have to remember that no one wins all the time. Every investor loses money sometimes, and that is just reality. I don't know anybody who's been doing this for a long time that hasn't lost money. And, surgeons have a saying, I am, of course, an ex-surgeon. And the saying is, if you haven't had a complication, like a surgical complication, you haven't done enough surgery. Now, that's as true for the best surgeons in the world as it is for investors, because sometimes things happen. Like this post-COVID rate hike thing, it happened, right? Just like, a surgeon who does everything right ends up with an infection, and all of a sudden you got, dealing with all sorts of other complications or whatever. It doesn't mean that something inherently was done wrong. Sometimes things happen, and you just have to deal with it. So what do you do? Right? So what do you do? It sounds like it could be potentially scary. But, the thing is, you don't have a lot of options. Sitting on cash guarantees you'll lose purchasing power to inflation. Think about that. Your money is sitting in the bank, and inflation is going, well, it was up to 8-9%. You were losing 8-9% of that money per year. You weren't sitting on safely. You were losing money. And even when inflation is relatively stable at 2 or 3%, you are losing money. Money markets, well, they barely keep up, right? So for me, the answer is to keep investing with some level of discipline. I mean, for me, that real estate is my medium. And like my father, I learned from my mistakes and keep moving forward. And that's what you just have to do is like you invest, you learn, you move forward, you have successes, you figure out why you were successful. You probably more importantly, when you don't have success, you have to learn from that too, right? Especially that. But I still see real estate as the greatest wealth building asset in the world, a consistent wealth building asset that if you stick with it, is generally speaking, I think a very good trajectory to be on. But that being said, wealth doesn't build blindly, right? It's just that you can't just say, oh, real estate, I'm just going to allocate some money to real estate and boom. Every project I invest in has to have underwriting I believe in. It has to be in the right market. It has to be a place where there's a need for jobs. I have to pay attention to the macroeconomic world and where we're at right now. I believe that in the right markets, real estate has bottomed out, and I think we're in the buyer's side of the cycle. Right. I also believe interest rates are headed lower, both because the Fed has signaled it, said it's going to lower rates, and because Trump's administration will do everything possible to keep them moving in the right direction. So basically investing in a descending interest rate environment, which is nothing short of a gift for real estate investors. But I digress. The point I'm trying to make here is that you have to get the macro, but then ultimately you start looking for deals and you got to get into the underwriting and you got to understand some of that stuff. Even as a passive investor, you don't have to know the absolute nitty gritty of everything, but there are some things that you should be looking for when you look at that underwriting. And those are the kinds of things we're going to talk about with my guests today on Wealth Formula Podcast when we come back from these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. As a result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Frank Gallinelli, founder of Real Data, longtime real estate educator, and author of What Every Real Estate Investor Needs to Know About Cash Flow. His work has helped generations of investors understand the numbers that really drive real estate returns. So welcome, Frank. How are you doing?
Great, thank you. And thank you for having me on your show here.
Yeah, well, let's start with Real Data. You started this company. What is Real Data for people who don't know? What was it and how does it work?
And how did I get here, too?
Yeah, right.
Because we've been around for a very, very long time. Real Data started off and still is primarily a software company. I can tell you what I purport to be the interesting story of how that actually came to be back in the early 1980s, of all things. But we produce analysis software, Excel-based models that have really expanded beyond, to quote a popular commercial, beyond your father's Excel model. But also eventually morphed into an education platform. We have online video courses that we offer, and we also try to maintain a reasonably active blog on our website with educational content, articles that are of use, I think, to real estate investors of all levels of expertise. Now, back in the early 80s, I was actually it was the late 70s. I was a commercial uh, sales manager. I was a sales manager at a commercial real estate firm. And everything was going along very nicely. And my mentor and my boss was one of the originators of the CCIM program. So that's how I learned income property analysis directly from him. Minding my own business when one day my sister calls up and she's was owning and running a real retail business, and her partner died, and her partner was the finance guy, and she knew nothing about finance. So she said, "Would you mind terribly just dropping your current career, moving out of where you currently live, coming down here and help me run this retail business, the finance side of it?" Now, the equipment that they were using to do this at that time might not have been out of place in a museum of World War II, things that came off an airplane. Even the adding machine, I think, had a crank handle. So that inspired me to see, what can we do computerizing this business? Now, personal computers were just becoming available. So I started with that. And then no sooner getting into that, the opportunity came up to acquire a piece of commercial property. And I decided, well, let me use this computer thing with some other software that also had just come out called a spreadsheet. And was well before Excel came out. And I did that. And after I did it and we closed the deal, bought the property and so on, a couple of my colleagues from the real estate business looked at this and said, "Hey, how did you do that exactly?" Thus was born a software company. I decided if this model was going to be of some use to me, might very well be of use to other people in income property investing. So kind of packaged it up, sold it, and it evolved, decade after decade. We're right now, I think, in version 20 after I can't even count the number of years now, more than 40 years. So we still have that software out there. But in the at some point in the middle of providing that software, I finally recognized that people who were calling up for support were very often asking, not which button do I push to make the software work correctly, but they were asking content related questions, right? Like, why is my IRR so high? Or why is my IRR so low? Or, why aren't you counting mortgage interest as an operating expense? Things like this. And I realized that there were a lot of people out there, even using our software, who maybe didn't have a clear picture of what it was that they were doing and what it was that they were understanding from the results they were getting from our analysis models. And that kind of launched me off into the second phase, if you will, of my commercial real estate career, which was education. I got invited by McGraw-Hill to write a book, which, there's no accounting for taste. That's now its third edition, and it's been very successful. And that in turn got me invited to teach this stuff in the Columbia Grad School. So that's where I got from where I was to where I am.
Well, so a thing or two about underwriting deals, and let's focus on some questions relative to today and some practical use. For example, like right now, higher financing costs still weighing in on deals. We'll see where that goes and the instability, even in that part of it. How do you see investors adjusting their underwriting? I guess in part for the higher financing, but also sort of a climate in which there is a lot of lack of clarity in which direction things are moving.
Yeah, there is a lot of uncertainty out there. We do see that among the people that use our software or are inquiring about our software to use it. So there is a lot of uncertainty, and of course, uncertainty always has a negative effect on every kind of market, and the real estate market is no different in that regard. I wrote a blog post kind of on this subject not too long ago, and I say, beware of wishful thinking.
Yeah,
that's kind of one of the warnings I think you have to be concerned with in the current market environment. The belief that rates are going to come down a lot because they just came down a little. that can throw you a curve because you may be thinking that, okay, I can go ahead and make some kind of a deal right now without doing my homework as carefully as I ought to, because I'm not going to worry about it. I'm going to be able to refinance this in a year or so because the rates are
Right.
going to be coming down.
Right.
So I think that's kind of the wishful thinking that comes into play here, and we see people still, even though they should be forewarned because of the uncertainty, they should be forewarned to, not to take shortcuts on due diligence, so on, still making some of kind of the classic mistakes that they make all the time. The wishful thinking that revenue and operating
Mm-hmm.
expenses are real and recurring, and not taking into account that maybe things won't always be the same. And, I almost kind of think back to 2008
Right.
when homeowners always believed that home prices would go up
Yeah.
until they didn't. Okay. So we're in that kind of environment now where I think we have to take a really more careful look. If you do your homework and if you do the analysis of the financials carefully, I think you can still make good deals even in this kind of an environment.
Yeah. Yeah. Um, Beyond pro formas, well, let's stick with pro formas for a bit. What's the most dangerous assumption you see people making? I mean, this might go back to your last,
Yeah, it really,
answer.
it really does in a sense that making the assumption that things are going to work the way they always worked in the past. That your operating expenses are not going to go up as fast as your revenue, so your revenue will continue to try to outstrip
Yeah.
those operating expenses. Um, they make a mistake. One mistake I've seen happen time immemorial, really, is not accounting for property management cost when
Yeah.
they analyze a property. I'll hear people say, "Oh, yeah, don't have to worry about that. I'm going to manage the property myself." So I got to tell these folks when they give me that explanation that, number one, you're telling me that your time has no value, which I hope you don't really believe. And maybe you're forgetting the fact that when you try to close this deal and the commercial appraiser goes out there, if you didn't make account for a property management cost, that appraiser is going to make that assumption. And of course, that's going to probably change your entire estimate of value because now your NOI is going to be less than you thought it was.
Yeah. Um, all of this is, again, just coming back to today's situation. I mean, it's just like, how do you even, I mean, okay, you have the fundamentals of the property, but when you have such things as cap rates and insurance, property tax changing so quickly in some markets, and um, and obviously interest rates, maybe they go down, maybe they go up. We don't know how much they go down by if they do go down. I mean, it just seems like and sometimes it's a real guessing game. Like, so how do you make sense out of so much, lack of clarity when you're modeling?
Yeah, I do tell people, and I've made it in my courses at Columbia and also in my online courses. One of the big things I always emphasized was that you've got to look at the data. I'm a numbers guy. I always say that you have to run the numbers if you're going to make any sense out of a deal. But I also tried to emphasize very, very strongly that you had to look not only at the numbers but beyond the numbers.
Okay. Yeah.
That you had to take a look at some qualitative factors, which I think sometimes folks will get kind of get wrapped up in the qualitative the quantitative analysis. They miss this. I think my Columbia students probably were relatively convinced that I was a nutcase because on the first day of class I says, "Well, this is the closest thing to a class in art appreciation that you're going to get in the finance curriculum."
Yeah.
And I said, because you've got to begin to learn how to look for the picture behind the picture, the painting behind the painting, if you will. I would give them these three words that I would put up on the screen in this big auditorium, for almost every class: perspective, discernment, and clarity. I say, there are things beyond just calculating your bottom line cash flow. Cash flow is important.
Yeah.
But there are other things that you have to look at. There's certain qualitative factors that come into play here. And if you ignore those things, you're setting yourself up for failure. And of those three, the one that I used to really emphasize the most, I think, was discernment. Looking at the financial data and trying to figure out, what's the backstory here? Are we looking at tenant quality? Are we looking at the direction of the local economy? I had an example that I used, and every year I almost had the same experience with this example. I would give them these case studies. They were all invented case studies, but each one was designed to try to illustrate some kind of a purpose. And so I would give them all the numbers about the leases on this mixed-use property. And one of the tenants in this mixed-use property, one of the major tenants, was a restaurant. And so the students would invariably come back with all their spreadsheets and all their numbers. I wouldn't tell them what the property was worth. You figure out what you think you might want to pay for it. And I would get this assignment, and they would come back and they would do their numbers. Now, part of the information that I gave them about this restaurant was that the food was lousy and the service was even worse. But guy had a 5-year lease, and a renewal option and all the rest of it. So my students would come back having dutifully taken all the lease data that I gave them, all the market data that I gave them about this location, and they would crank out the numbers as to what the rate of return would be and what they would pay for the property and so on. And the thing that always happened that I always looked forward to was that at least one person would raise his or her hand during our discussion of this case in the class and say, you know what? This case is all BS. And I said, oh, really? Why is that? Because I don't care what numbers you gave us about the lease on that restaurant. This guy is going to pull a grapes of wrath. He's going to throw grandma on the back of the pickup truck in the middle of the night, and you're going to walk over there one day, and there will be no restaurant there. And now, have you planned for the rollover vacancy? Have you planned for the leasing commission? Have you planned for the fit up allowance for a new tenant and all that? Have you put all of that into your pro forma expectations for how this property is really going to work? If you haven't, then you've missed the whole point of this case study, because you ran the numbers based on what the lease has said, but you didn't look at tenant quality. You didn't look at the backstory on what's really going on here. So although I remained the guy who's all about the numbers, I says, well, you're going to have a different set of numbers that you want to look at here, a set of numbers that's based on what is more likely to occur than what it appeared to be just on the lease data. So, you got to figure that you have this alternative reality that you're going to have to prepare for if you're really going to look at this property and learn how to analyze the property. And one of the things I also with those three, that mantra of three things, I would also emphasize, a point of view. I said, you've really got to make sure that you're looking at this from everybody's point of view, that not only as the potential buyer of this, but also as all the interested parties in this potential transaction. Because if you want to try to figure out how to make this deal work or how to make any deal work, you're going to really have to be looking at it from everybody's point of view.
From the standpoint of multifamily real estate, our group is involved in quite a bit of that. And when we look at properties, and maybe this is kind of the equivalent of bad food or good food or whatever, we start not with the property, but we start with the market and the demographics of the market. We look at, okay, what is population growth? Okay, number one, population growth. Well, I should say number one, jobs. And then number two, population growth with the anticipation of more jobs, because ultimately that's something we can't necessarily, put on a spreadsheet. You can to a certain degree with anticipation of, what you think your rent growth might be or whatever. But that sort of the equivalent of what you're talking about when you say looking outside of those numbers and the spreadsheet?
Yeah, absolutely. Sounds like you may have read my book, and I think that's in one of the first chapters.
Yeah.
That entire set of parameters that you just mentioned. Said you've really got to be, kind of like the guy in the musical that said you got to know the territory. Well, you really do have to know the territory, because it's not just about the building, it's not just about the current rent roll, but just take a look at the jobs and the market dynamics. You have a major employer who might be moving out. Well, if you do, then you have a whole new set of parameters that you have to deal with your multifamily property, because now you're going to have people who are perhaps getting laid off, getting unemployed, can't pay the rent. So the demand for apartments is going to shift around. On the other hand, let's say you've got a situation such as we've seen recently, where there are no listings, no houses to be bought. So what do people do? They have to rent apartments. So
Hmm.
kind of a counterintuitive aspect of the single family real estate market is that when things are bad in terms of inventory availability in the single family market, that pushes people toward apartments, because if you're going to go someplace, you're going to have to find someplace that you can go to. And so, yes, all of these things come into play. Is that are you paying attention to the local politics and to the local budgeting process? Example I use in one of my books is that what if they're planning now to build a new high school? What's that going to do to your taxes?
Yeah.
Okay, you're going to have to pick up the expectation of an increased property tax expense. So don't just look at your current property tax expense, but try to look forward on this. Nobody's got a crystal ball. Nobody's going to come up with a perfect set of assumptions and a perfect set of numbers to make these projections on. But you have to be more attuned into what's going on in your marketplace. So yeah, absolutely.
And you also have to have some sense of, what your convictions are in terms of really what's happening with the market, what's happening with rates based on your understanding of macroeconomics as well. And, you kind of have to look at the big picture. And if you look back just a few years ago in multifamily, it was a kind of a big shock with interest rates going way up. I mean, it was not just for multifamily, but that's something that, if you could have predicted that you would have made a lot of people made some big moves. And unfortunately, I don't think anybody could have predicted that, but you do have to make some assumptions. And I guess that's the ongoing challenge, right? So,
Yeah, absolutely.
yeah.
Yeah.
So, you're a big advocate, I know, for stress testing. Can you share maybe some examples of how running downside scenarios can change the way you look at a deal?
Yeah, absolutely. I think we even built a special module into the pro version of our software specifically to deal with that issue, where you could take one page where all of the assumptions were. You could ratchet each assumption up and down to see how it might affect the bottom line on the investment, because it's dangerous to assume that all of your assumptions, even if they're accurate today, are going to remain accurate in the future. You got to be thinking about, okay, yeah, I can run the numbers on what I know right now, and I can run them going out based on what I think is going to happen with the numbers that are accurate today. But then you have to ask yourself, stuff happens. What happens if I lose a key tenant or two? How's that going to affect my bottom line? What if I have to replace a furnace or an AC unit sooner than later?
Mm-hmm.
And what, as we discussed a moment ago, what happens if I get an out of the, a greater than ordinary property tax increase? I got 2 months notice that my property taxes are going up 20%. So if you can stress test the potential holding period and plug in some of these options, see what happens if you do lose that tenant or two. See what happens if you do have a big capital expenditure or an unplanned increase in OPEX. Test these out and see what it really does to your cash flow more than anything else. And when you do that, you say, well, I don't know the exact probability of any one of these things happening, but let's say some of these things feel more likely than others. And so let me do my pro forma going out with these various scenarios. And if I look at these, I might get a sense of the need to put some of my regular ongoing cash flow into reserve rather than simply taking it out this thing and treating it as if, that's my income for my in-pocket income for this year. Look
Yeah.
at these different, stress these things out, try them out and say, well, okay, it looks like I got a possibility of losing that tenant in year 4. So maybe in years 1, 2, and 3, instead of taking my cash flow, putting it into my checking account, my personal checking account, maybe I want to maintain a reserve account, put it in there. If nothing happens, fine. It's still my money. But if something does happen, then I don't have to go looking under sofa cushions, to find the cash that I need to cover these things. Stress testing is I think an essential. Alternate scenarios. I've always said, again, in my courses, in my books, all the rest, that at the very least, what you ought to be doing when you do a pro forma that goes out a number of years is to do a best case, a worst case, and an in-between scenario. Because in real estate, as in life in general, things are usually not as good as we hope for or as bad as we fear. It's usually somewhere in the middle. So if you can kind of identify where the middle is, then maybe you can ask yourself, oh, can I live with being in the middle? Is that an acceptable return on an investment, an acceptable scenario for me as an investor? If it is, then maybe you got a little bit more comfort going forward.
So a lot of professionals invest passively into syndications, such as in our group. If you had to boil it down, they really are not digging that deep into these metrics. I mean, we certainly provide the underwriting and give the story of the demographics and stuff like that. But if you had to boil it down for those people, which numbers should they never ignore?
Okay. Well, as you may be aware, the title of my book is What Every Real Estate Investor Needs to Know About Cash Flow and 36 Other Key Metrics or Investment Measures or whatever the title is there. I don't suggest that anybody try to examine 37 different metrics before making a decision. But I think there are maybe 3, 4, 5 that are absolute, that you absolutely need to take a look at. First of them is cash flow. Now, I'm not saying so much cash on cash return. I know a lot of the people that we talk to think that that's really what they want to look at. But I think could be too easily misleading. But cash flow itself, in terms of dollars, I think is probably the gold standard of what to look for. It doesn't necessarily mean that a negative cash flow is a deal killer, because you may be in a situation where you're buying a property where you have maybe a value add scenario that you have really worked through, and yet that if you can get through the negative cash flow period, that you're going to have a stable and very profitable investment. But I think you need to know projected realistically what is likely to be your actual cash flow.
Yeah, and just to add one thing to that, one of the things that I noticed, we're in the business, of value add commercial a lot of times, and in the past there has been slight negative cash flow, but right now, because of the corrections in the market and a lot of the properties that that are distressed, one of the advantages right now, I don't know if you're seeing this, is that you can in many situations buy properties at today's interest rates and actually from day one have positive cash flow, which is actually kind of a nice situation for, we for a while that was really hard to do. And just your comments on that before you go on to the next.
I think you're right. There are situations out there. You got to be careful. You got to be, look, and you got to, again, always run the numbers with a conservative mindset. But if you do, it's not impossible, I think, to find those. It's getting back to my blog there. I wrote a recent article about how, if you really do a conservative and careful analysis of the data that you're coming up with, then you'll be able to identify opportunities like that. if I may return to your question about
Yes,
the
yes.
metrics, uh, another one, and this is one I find curiously that a whole lot of people I talk to just it just never gets on their radar somehow, is debt coverage ratio.
Mm-hmm.
Now, I can't imagine why you wouldn't want to take a look at the debt coverage ratio on a potential investment, and I can think of at least a couple of reasons. The one that comes most immediately to mind is that if your debt coverage ratio isn't adequate, uh, you're not going to get the financing, so you might as well go home. Uh, and game over kind of thing. But even even if you are getting the financing, I suggest that in our software we look at the debt coverage ratio on a year to year basis. We can go out 20 years and look at what is it each year in our projection, because we as owners we wouldn't want to be in a position where our debt coverage wasn't adequate, where it didn't have at least 20 or more likely 25 to 30% wiggle room to make sure that we can accommodate surprises. So you don't want to not pay your mortgage, obviously. So you want to make sure that your NOI is going to be at least 20%. No lender is going to give you a mortgage if you don't have at least 20%. And I think the current standard is 25%. And I think prudent investors even look for a greater uh, amount of leeway in their ability to cover their debt. So I would put that right after cash flow as a key metric that you really ought to be paying attention to. My next one would be internal rate of return, IRR. Now, there's a whole lot of people who don't like that. They think it's like witchcraft or something. That's like magic. That it depends on maybe able to predict the future and all the rest. But the one thing that IRR has over a lot of other ways of evaluating the worth, the viability, if you will, of an investment opportunity, is that it takes into account simultaneously both the timing and the magnitude of cash flows, the interaction of how those two things interact with one another. I've given plenty of examples in my articles and so on, where you can see how, if you look at a 10-year holding period with two different series of cash flows, which add up to the same amount, but the timing is different. It makes a big difference on your rate of return, because sooner is better than later, obviously. So that if you can see how the interaction works between the timing and the amount of the cash flows, and you can see that through the internal rate of return, that's one of these metrics that is a good one to use with stress testing. Because if you adjust your parameters, if you adjust your timing on revenue or revenue increases, expenses, and or in when you make expenditures for capital improvements, for example, if you could play around with those and see how they affect your internal rate of return, you get a better sense of, maybe if that roof will last me another 2 years, that's not such a bad thing, whereas the total number of dollars may be the same involved in every one of these scenarios, but the actual effect on your overall return and on how successful you're being as an investor is, I think, is key. And
So I
probably
think a lot of people don't quite understand IRR.
oh
I
yeah,
mean, and so, I mean, to the extent that, if just to give the 101 on it, I mean, annualized return is fairly easy. You're just kind of doing some arithmetic there. But IRR is taking into account the time value of money. Can you explain that a little bit, just in simple terms for people to understand?
yeah, the time value of money issue is really pretty straightforward. And I've got a couple of, if you want to get a little bit more into depth, anyone who's listening wants to get a little bit more into depth, they can go on our website blog, and I've got a couple articles there that really walk you through how to understand what IRR really means. But time value of money simply says that a dollar you get today is more valuable than a dollar you have to wait for to get tomorrow. So if you loan me $100 today, and and you want to get paid back, well, if I pay you back right away, well, that's different than if I pay you back 5 years from now. Because if I give you that $100 back 5 years ago, you have less buying power with that. So the longer you wait to get a return, the less valuable that return is to you because it has a lower buying power. If you get the money back sooner, you can reinvest it and earn more money with it. But if you have to wait till later, you've lost the opportunity. There is an opportunity cost to waiting to get your money. And IRR is sensitive to that. IRR, basically fills in the blanks for you and tells you what that opportunity cost is, having to wait to get for your return.
Any other guardrails or, non-negotiables for people to look at other than those main features you just mentioned?
Yeah, I think when it gets down to basic discipline, if you want to call it that, in terms of your investment activities, one of the key things that I've always urged people to do, and again, I go over this in the prologue to my case study examples, is the subject of clarity, knowing in your own mind why it is you're investing in a particular piece of property, because there are different reasons, different motivations that might direct you toward a particular piece of property, and the type of property that you get, and really needs to be in sync with your motivation. If your motivation is that you want to build long-term wealth because you're thinking about your retirement, or maybe you're a young couple and you're thinking about putting your kids through college, the kind of property that you might be looking at and the kinds of metrics that you're going to be looking at will be different from someone who is looking for a quick turnover, a quick hit. Okay. That individual would be looking at different metrics and making different kinds of assumptions. If you're looking at just something that provides kind of ongoing annual cash flow, that's a different motivation also, and it directs you toward a different type of property. If you're looking at triple net lease property, this may be something that you think of, and again, if you're looking to protect your retirement, because you may be willing to accept a lower rate of return as a trade-off for the security of a triple net lease property. You don't have to worry about what happens to the property taxes. The tenant's going to be taking care of all the maintenance and management of it. You don't have to worry about the insurance cost because the tenant's going to be paying that. So in a situation like that where you need security and you're willing to trade it off against some degree of the return, well, that's fine. But you can't do any of these things until you first have a clear mind of your own. What do you want to do? And why do you want to do it? So if you can answer that question for yourself, I think you've overcome the first hurdle to being a successful real estate investor.
Yeah. Where can we learn more? Tell us, and one of the questions, I guess, is the software, is it appropriate for retail investors as well, or is it just large operators and that kind of thing? Who's it for, and where can we learn more about that and everything else you're doing?
Okay, so in regard to the software, realdata.com is our website, and you'll see several different applications that we have there. We have a professional level of the income property analysis, and we have what we call Express, which is generally comfortable for people who are dealing with multifamily or very small commercial properties. But I will tell you that our typical user is the entrepreneurial investor. We don't really deal as much with the institutional investor or the one with dealing with large holdings. I mean, we do definitely have some, but I think our typical demographic, if you want to call it that, is the entrepreneurial investor.
Yeah.
We also have some software for developers, whether income property developers or subdivision land developers, condo developers, that kind of thing. So there are some applications for that, but kind of our flagship product has always been our income property development. So we have income property analysis. So we had basically two levels of that. One that's a little bit more for the entry level, and one that really does extensive analysis. You can go in as deep as you want or as light as you want. We even have within the software, we even have kind of a quick and dirty analysis if you just want to get an idea of, is this even worth looking at in more depth. Then on the learning side, on the educational side, and this has been a big thing for us, especially over the last couple of years. I used to teach this, as I said, at Columbia as an adjunct. I did that for 14 years, I think it was. And now over the last couple of years, there have been a number of professors who have been either assigning or recommending our online video courses, which take you through actually more than the stuff that I taught in the grad school, because I kind of morphed the grad school material, and then based on requests that I had, we added more and more content to it, so that we added stuff on development. So we added stuff on partnerships and on value add and that sort of thing. You can go to learn.realdata/courses, and you'll see the inventory of those courses. And we do make special, if anybody out there is listening to this is in the education field, we do make special pricing for student groups so that it becomes, considerably more affordable for those who are in college. I've done that with the University of Alabama. I've done that with even with Columbia after I stopped teaching in person.
Frank, thanks so much for all your time. Frank Gallinelli, founder of Real Data. Appreciate being on the show today and giving us all this useful information.
Well, thank you. Thank you for having me. It's a pleasure talking with you today.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. Meanwhile, you've got a mortgage, private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. Great conversation. And again, the morals of the story is, listen, you gotta, there's multi-prongs to this thing. It's not necessarily as, difficult as it sounds. It's a handful of things you should be looking at in the underwriting. But beyond that, beyond the underwriting, I think that it's really important to think about a few other things, right? I mean, you really want to make sure that you're in the right market. You want to make sure there's jobs. Jobs mean population growth. When markets get frothy, you start seeing places like Oklahoma City starting getting really expensive. Well, that never turns out well. And then perhaps one of the hardest things to do is to have some idea on which way the winds are going to blow in the economy. The challenge with what happened in, after COVID with interest rates was that it really fooled everybody. I mean, even the Federal Reserve, as you may recall, they said that inflation at that point was transient. And so, it's hard when the actual United States Federal Reserve gets it wrong and tells people the wrong information. Hopefully that doesn't happen to that degree ever again, but sometimes those things are going to happen. You have to use your best gauge of what's going on. Personally, I think right now we're looking at rates that are going to continue to take down as unemployment goes up, as AI continues to take over jobs. I think that there will be an ongoing and growing need for housing in the working man sector. In other words, not poor but not rich, and that's where we're at. So that's it for me this week on Wealth Formula Podcast. Hopefully you enjoyed the show. Our investor club is available to you, obviously, by signing up at wealthformula.com. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Wheelwright and Ken McElroy. Visit wealthformularoadmap.com.